We often refer to our investing strategy as a personal endowment strategy. You may have heard of a college endowment fund, with some of the more famous ones being the Yale Endowment and Harvard Endowment. In this education module, I'll describe how an endowment style portfolio is different from a more traditional personal portfolio, and why we think there's an advantage in modeling a portfolio after a college endowment, at least to the extent possible for investors with less than, say, $4 or $5 billion. This video is for informational purposes only, and nothing in this presentation is intended to recommend or imply any form of financial advice. Let's start by describing what an endowment is. These tend to be very large portfolios, and they're used by universities for funding scholarships, research projects, professorships, things like that. Because they have these regular requirements to spend money, they actually have guidelines, and typically the spending targets are right around 5% per year. Then they also have growth targets, usually in the 7 to 8% range, to make sure that they're continuing to grow and they're able to keep up with inflation, things like that. So some of the best known examples are universities like Harvard, Yale, Stanford. These all have multi-billions of dollars in their endowment funds. When we think about what the goal of an endowment is, it's actually very similar to a pension fund, and in fact, very similar to a retirement fund. They all have two common goals. Number one, don't lose a lot of money. Number two, make enough income and growth to fund your expense needs. So if you're an endowment, you have a 5% spending target that you need to hit. If you're retired, you have a certain living expense target that you need to hit in terms of income. So the goals of whether it's an endowment or a pension fund or a retirement fund are all very similar. And so it kind of makes sense to take a look at how endowments meet their targets and see if we can learn something for a retirement fund. I believe that the factor that drives how we design a portfolio the most tends to be how we're going to measure success. Kind of makes sense. And by far, the most traditional way, or the most widely used way of measuring success, is to see how we did relative to the market. Did we meet or beat our market-based benchmark? So I used an example here. I took the S&P 500 results for 2018, that's in purple, and I just built a hypothetical portfolio. For every day that the market went up, I increased that daily return by 2%. And on any day during 2018 when the S&P went down, I reduced the daily loss by 4%. So in gold here is a hypothetical portfolio that beat the benchmark every single day of the year. And by the end of the year, it was up 5.8%. So by most measurement standards, that would be wildly successful. But if you take a look at this, you actually made no progress to any financial goal. Now, how could this be? If you beat your benchmark every single day for an entire year, how did you not make any progress to a financial goal unless the benchmark has nothing to do with your financial goals, which is the case with market-based benchmarks. The other method of designing a portfolio and the measure for success is what I call goal-based investing. This is where we pick a very specific goal, which most people have. They know that they need a certain amount to retire, and they also know at what point in time they need to accumulate that money. And so we can draw a line and figure out how much does the portfolio need to grow in order to meet our goals. That's a very different measure of success, and therefore the portfolio will be designed very differently. And that doesn't happen just by accident. We'll take a look at how we do that, but this is a key difference in how portfolios are designed. Portfolios will always be designed to stay relatively close to their benchmark or their measure of success. And so if you have a market-based benchmark, portfolio will tend to follow the market, whether it's up, down, or sideways. If you have a goal-based benchmark, then we'll try to design a portfolio that beats those goals. In order to design a portfolio that doesn't just follow the market, but is actually more oriented towards our goals, it really comes down to diversification, or owning investments that don't all do the same thing at the same time. So I have on the screen here something called the Morningstar Style Box. It's kind of the traditional way of viewing diversification. And it says that as long as we own some large company stocks and small company stocks and something that we call growth and value, although the financial world is always arguing about what those mean, maybe some US stocks and foreign stocks, if you have all these different types of stocks, that then somehow you're diversified. But we all kind of know that when the stock market goes up, just about all stocks go up with it. And when the market goes down, stocks tend to go down together. So really what we have here are a lot of versions of the same thing. Kind of think of those as different colors of M&Ms. Fundamentally, they're doing the same thing. That's fine in a portfolio, but we would consider this to be just one investment type. And I like to call that unhedged stocks or unprotected stocks. In other words, there's no downside protection to them. In a traditional portfolio, then, you would have unhedged stocks, which is little tiny slices of ownership of public companies. And you would own bonds, which are the debt of those public companies. We're just loaning them money, and they promise to give us our money back someday, although there's nothing actually behind it other than the company's promise. But there's other things that we can invest in that don't all operate the same way. If we own unhedged stocks, there's a bunch of mutual funds out there that are hedged stocks. They actually have downside protection. When the market's going up, they tend to get increasingly aligned or correlated with the market. When the market goes down, they tend to get increasingly negatively correlated to the point where they can even make money if there's a strong downtrend. Also, the public debt market or the bond market is actually just a tiny slice of the overall debt and credit markets, and there's a vast world of private debt. With public debt, that's considered unsecured bonds. There's nothing behind it other than a company's promise to give you your money back. When you're dealing with private companies, they have to put up collateral, and they also tend to have to pay a much higher interest rate. So again, this is just another investment that we can take a look at. There's some other different types of stock-oriented investments. I tend to like the energy infrastructure sector because of all the energy that the U.S. is producing. That all has to get shipped somewhere. I think that that's an area that's still undervalued. Private preferred stock is kind of a hybrid between a stock and a bond. So we kind of think of that more on the credit side. So instead of just bonds, we think of it in terms of overall credit. Then there's some other things that we can do, and this I have a whole separate module on, which is our bank notes, which tend to be customized for our practice. In general, what these allow us to do is define our outcome over a span of, call it 5 or 6 years, and in exchange for defining our outcome, saying that we'll be okay with, let's call it a 9% return, we can give up a lot of our downside or the risk of losing money. So it's a way to really get aligned with goals as part of a portfolio, not the whole portfolio, but just another piece. And it allows us to define our outcome within a certain time frame. It's a great tool. And then finally, we have investments that just don't fit very well in a traded vehicle. Maybe it's real estate, maybe it's a bunch of solar fields producing renewable energy. These are things that don't just exchange hands every day. And so we have to give up some liquidity and own them as part of partnerships. But again, another great tool to add to a portfolio in order to smooth out returns and being able to capture returns that are completely independent of what the stock and bond markets are doing. So instead of just calling these things stocks and bonds, we think of it in terms of growth assets and income assets. And we have different types, we have different strategies within those types, even different time frames. So a lot of times we get asked, well, what is your investment style then? And there's all these different styles. Is it aggressive? Is it moderate? Sometimes you get moderate aggressive. I've seen some advisory practices where they might have 20 different portfolios. And all these different names, what they're really telling you is how much stocks versus how much bonds do they have. An aggressive portfolio will have more stocks than bonds. Conservative is the other way, but it's just different mixes of stocks and bonds. I don't like any of these when we describe our portfolio. What we're trying to do is actually more deliberate investing. We want to have a specific goal within a specific time frame. And therefore, instead of just throwing our money in the markets, we only want to take as much risk as necessary. A lot of times when people are investing in the market, they're trying to do cost minimization. The theory being that the lowest cost investments are going to be the best. We think of it more as cost optimization. Where are we going to spend our investment expenses so that we get the most bang for the buck? And then ultimately we want to preserve capital through all of this. Probably the worst thing to trying to meet a goal is to end up going backwards. And so we want to minimize the chances of moving backwards and always be making forward progress to goals. To summarize the difference between traditional investing versus more of an endowment style investing, it really comes down to what goal you're focused on. With traditional investing, the goal is more performance-based. So it's, can we beat the market? How did we do relative to the market? Ultimately, the stock and the bond markets are the measurement. With a personal endowment strategy, it's much more deliberate goal-based investing based on your financial goals. So we ask different questions. What's the required return that we need over a specific time period in order to meet your goals? How can we then meet or exceed that required return with the highest probability that we can manage to get? When we do it this way, then the measurement of success is progress to the goal, not how did we do relative to the market.